Yeah, conservative generally means what? Not going overboard and coming to a conclusion too easily. So in accounting, for example, when it comes to determining net profit, accountants are very slow to say the net profit is until they've made sure that the revenues are what? Properly accounted for, and all of the expenses are properly accounted for, yes. Once all that happens, then under the conservative principle, we say the net profit is X, whatever it is. Okay? But the key is we are slow to come to any profit figures because we want to make sure that we cover all the what? Probable losses and expenses.
Yeah, but you're sitting down and you're trying to assess your own personal value. Let's just say you have a couple of assets. You go, oh no, this property ain't gonna work for so and so and so. My car, what? You automatically go, you try to assess when you're doing your own stuff, you try to get the best value.
Yeah, it's kind of getting on the best value thing. When in fact you know that in reality,
I think I can get 5, 6
yeah,
for that.
you think so. But yeah, but 4 is probably the more what? Practical figure. You follow what I mean? If you're involved in a lawsuit, you say, I'm going to win the lawsuit, so I don't have to account for the $3,000 I have to pay in fees or whatever. So you don't include it in your expenses, when in fact you should include it. Because what happens if you lose? Okay? So the accountant, under the conservative method, tries to take all of these things into account. Calls for a lot of judgment and making sure that we don't, like she said, kind of try to do things that we feel are in our best interest as opposed to what is really practical to do. We always want to do what's in our best interest. But to be conservative means sometimes we have to do things that may not be as grand as we would like them to be, but it is the correct thing to do, by all means. So that's the conservative approach. Any more principles? Yeah, there are a couple of other ones. The economic principle is very simple. It simply means that every entity that sells goods and services is considered to be an economic entity. That's all that is. Any entity that sells or provides goods and services is an economic entity. We already talked about the monetary unit assumption. Remember that one? So we can move on. What do you think the time period assumption is? Basically, that accounting periods can be broken down into time frames, like monthly statements, quarterly statements, annual statements. That's what the time frame assumption is, time period assumption. Normally, we don't report over 1 year in accounting. Okay? We usually report for a month, or a quarter, or semi-annually, or annually. Normally, under the time period assumption, we do not report any period over 1 year. So you wouldn't see a financial statement that's 2 years old or 3 years old. You will not see that. It'll always be as at the end of the year, as at the end of the quarter, as at the end of the month, that sort of thing. No, it doesn't go more than 1 year. That's the time period assumption. The cost principle we already talked about. The full disclosure principle simply means that any information on the financial statements that cannot be shown in numbers must be written in words at the end of the financial statement as notes. Does that make sense? In other words, if you have a balance sheet with numbers on it, and there are some other things affecting those numbers on the balance sheet, and you need to say something about it in your note. Note number 1, this car was purchased for $4,000, but we believe we can get $15,000 for it. Note number 2, we didn't show any expenses on the income statement, but we expect that we're going to lose this particular law case and that it will cost us approximately $33,000. You follow? So any information that is not shown monetarily or in dollars and cents have to be disclosed under full disclosure principle as notes to the financial statements. In case you're sitting on the board and you see a balance sheet with a bunch of words written underneath, note 1, note 2, note 3, that's what this is. They're following this principle. And let me tell you, as potential board persons and committee persons, whenever you get a set of financial statements with notes on it, please read the notes. Most directors don't like to read the notes. Everybody's so busy what? Partying. Having fun. Nobody wants to read the notes. And part of the reason is, a lot of times the notes are so sophisticated for some of the board members, they don't understand what the hell it's saying anyway. Because a lot of board members are not what? Accountants. And they wouldn't come and do a course like this. Because they figure, I'm a board member, so I've eaten the fruit, I know it all. I'm like a god. How about that? But not really. These notes are very important. We talked about the going concern concept. What about the matching principle? I don't know if anybody's ever heard that. Yeah, the matching principle. Yes, you did. That's where we heard it. The matching principle says, for example, if you generate in your business revenue of $50,000, what is revenue? Sales, right? Revenue and sales are the same. How do we get revenue and sales? By selling goods and services, or goods or services. Whatever it is you're selling generates revenue, or otherwise called sales. So if your revenue is $50,000, something had to happen for you to generate that, correct? In that year. What kinds of things would have happened to help you generate this $50,000? What kinds of expenses would you have incurred?
Purchasing.
Yeah, you have to purchase the goods, called inventory, correct? Well, this is the sale up here. What else happened to help you generate this revenue?
Labor.
Sorry?
Labor.
Yeah, labor. The most expensive expense most times. Salaries and wages. Okay? Labor. Very important. Anything else helped you to generate that? Did you sell these things on the dock or in a room? Yeah, if you rented a spot, then you have to pay rent. Right? How about that? BC bill. A dog eat your lunch. Utilities, which are light, water, phone. All of these fall under utilities. And this could go on and on. Okay? Now look at what is interesting. So under the matching principle, we say this. Whenever you generate revenue in a particular period, see that? Which is monthly, quarterly, annually, then the expenses that you incurred to generate this revenue has to be shown in the same period as that of when the revenue was generated. In other words, you can't say this rent is too high for this year, I'll show it next year. You can't do that. Okay? This rent was part of this year's revenue, so you have to show rent expense this year. That's what matching means. Don't mismatch. Okay? So let us suppose there are a list of other things here, expenses, and suddenly your expenses come up to $75,000. Is that good? Why is that not good?
You're at a loss.
Because your expenses are now greater than? By how much in this case? 25,000? So you have experienced a net what? Yes. See that, folks? Suddenly the concept of an income statement falls in front of you. That's all it is. In case you were wondering what an income statement was. All the revenues that you generate from selling, whatever it is you sell, minus all the expenses that you paid, not paid, incurred. Because sometimes people incur expenses but they don't. That's why BEC has to come and turn off. But whether you paid or not, for accounting purposes, you still have to what? Record it. Do you follow that, folks? Yes. I paid, so that's why I recorded. You can do that if you're running your own little bookkeeping thing. That you are not trained to do. Because you know a lot of people have their little thing going on. They think that they're everything. They're great marketing people, accounting people, everything. They don't want to hire somebody to help them do the job right. And obviously they run into trouble.
So concerned with when you say sales and revenue could be used interchangeably? Sales.
Yes.
Okay.
Sales and revenue are interchangeable. So total sales would be the same as total revenues. Yeah. And then the revenue recognition principle Now, what do we mean by revenue recognition? It simply means this. Revenue, which is this, has to be recognized in the same time period in which it was what? Earned. You follow that, folks? So if you earned $50,000 this year, you can't put it in your financial statement next year to make next year look better. You follow that? That has to be recorded when? This year. No matter how next year looks, how it stinks it looks, you cannot transfer this year's revenue to next year. The revenue has to be recognized in the year or the period in which it was earned. So if you earned it in 2018, you have to record it for 2018. Simple as that. It's not complicated at all. Of course, we sometimes complicate things by trying to violate the rules. Imagine if that chick did not listen to that snake. How much more simpler our lives would have been. The same principle.
What if you have revenue that you've gotten, but you haven't yet earned it, you haven't yet fulfilled the order for the goods or the service?
Yes, good point. If you've gotten money,
Right,
but you haven't provided the service yet.
right.
That is a unique situation in accounting, and we call that money that you've got. Here's what we do with that money since. All right. Here's what we do with that money. Using the golden rule, how's that again? What came in? Income came in, but it's very subtle. See that? What really came in when she received, give me a figure. She received $5,000 for a job service she has not yet provided. Okay? Cash came in, right? So what do we do with what comes in? Debit it. So we debit cash. For how much? And remember, this entry has to be what? Balance. Yeah, double balance. All right, 5,000. And what is going to go out? Service. And so we credit what? Goes out. Now, we don't call the service revenue yet, because no revenue has been earned by her. Correct? She hasn't provided the service yet. So since she hasn't provided the service yet, we call it unearned revenue. We still record it because she has the money. See, you can't say, I'll keep the money without recording until I provide the service. No, not in accounting. Once you receive the money, you have to prepare it. Yes, it has to be recorded. It has to be. Doesn't matter what your mood is. All right? So this is what will happen when you receive the money. Now, let us assume then next week she provides the service. What do you think the entry will be then?
Debit unearned revenue.
Debit unearned revenue, because now this is being removed, correct? So we debit unearned revenue for how much? 5,000, which removes that, doesn't it? And then what do we do? Yeah, credit revenue. Revenue for how much? 5,000. You probably would have noticed by now that on the journal, the debits are to the left and the credits are indented to the right. That's how we record it for accounting purposes, just to distinguish. You could put it here, but if you put it here, it looks a little, cloudy. All right? Does that make sense? That's a good point. What made you think of that?
Because a lot of times you would pay for something that you haven't gotten. Let's use this as an example.
Yeah.
You pay for the class before you actually start going.
Yes.
So
No, you're absolutely right. Very often we receive money before we provide the service. As a matter of fact, when my kids were in school, I always was the devil's advocate sometimes. because I would raise the question to these schools that like to tell you to pay school fees up front. And so one bright day, I said to someone, why is it that you are requesting money before you provided a service? Because anywhere I go, I have to provide a service first. Then I seek payment. I can't go and say, pay me first. They didn't like that. It's true. Because that ran amok to the customary way of doing things. But technically, they should teach the hell out of stuff first.
Right.
Then,
And you understand that your kid there for the next semester, they don't get that money.
of course. So they pull Trump on me.
If people stop
If
carrying on
I,
and
yeah, if I don't pay first,
This child is disowned.
then they say, you know, like Rodney Martin said, take that Negro out. All right. Any question on the revenue recognition? So yeah, so these are the principles. And remember, just like anything else, principle means it's something on which you stand and you don't change it no matter what. Okay? So if you don't take bribes, that's a principle that you have, no matter how much they present. So if somebody presents $10, I don't take bribes. So they say, here's $100,000, I don't take bribes. Here's $5 million. Do you understand my principle? I stand by my principles. There's 10 million. Didn't I say stand by my principles? So at what point will you not stand? But in accounting, you don't have a choice, quote unquote. These are the principles. They are not to be violated. Okay? Of course, in practice, people still try to violate some of them. Sometimes to their own detriment, sometimes to the detriment of the firm. And that's why we call them principles, because they're not supposed to change. So raise the warrants. That's a good idea in accounting, and that's a good idea out of accounting. How's that? Okay. That's a good idea if you're a board member. If you go to sit on a board or committee or something, you need to sit on it with a certain amount of principles, shouldn't you? Because if you fall for anything, then what's going to happen? Well, just talk to any board member who wants to be honest, and you might discover what happens. Okay? But that is not what is required of you under proper corporate governance and under GAAP. Okay? In both cases, you're responsible to do things according to the principles and the rules. All right. Now, in accounting, we have this phenomenal thing that we call the accounting cycle. When you hear the word cycle, what comes to mind? Yeah, something that goes around and around and never quits. And accounting is quite like that, the accounting process, because there are certain things that we do in a certain sequence, and when we get to the end of that sequence, we start all over again. So we get to the end of that sequence, and we start all over again. And so we call this the accounting cycle, because this is what we call the process of recording information and events of the company, otherwise known as transactions. Remember I told you the last time, nobody should be recording anything until it has already occurred, not on the way. I don't care what your boss tells you. And don't record anything without a source document. I'll just write it down here and sign it. Excuse me? Maybe. But boy, even if he or she signs it, that could still get tricky, could it not? Depending on how much is written on that piece of paper. And how much that piece of paper carries in weight, if any at all. But remember also, nothing is a problem until something goes what? Wrong. And all of a sudden, the person you thought cared about your welfare, absolutely, right deep, and swear on a stack of Bibles. God knows it. It wasn't me. That chick did that on her own. As a matter of fact, I told her many times before.
About that.
Whatever it is to save, somebody save their own tail. that is a very serious governance issue that I just mentioned. And a lot of people get into deep, deep trouble because they violate those kinds of things. They let people pressure them for whatever reason. A promise of promotion, money, trip on their chopper, a cruise in the Exuma Keys on their yacht, whatever the hell it is. Yeah, and people go ahead and make the mistake of falling prey. Okay? All right. So how does this cycle work? Very simply, in principle. The first leg of the cycle begins with what? Identifying and analyzing business transactions. So we did that earlier when Tanika raised the question, suppose I got the money, I haven't done the service yet. Well, how did we analyze that? Simple. First of all, she got the money. Secondly, since she already had the money, she had to make an entry. Now, what entry is appropriate? See what I mean? That's all part of step one in the cycle. And we do this for every single accounting transaction. As a matter of fact, even seasoned accountants, depending on how complex a particular type of transaction, let's say they're dealing, making an entry for a derivative transaction or some other weird stuff, some lease purchase arrangement, all these have very unique processes. And therefore, each one of them have to be identified and analyzed individually. And sometimes even seasoned people make a mistake. Come up with the wrong what? Analysis. Therefore, and when the analysis is wrong, then what's wrong? Of course. Okay? So if you marry a dog, how can you expect a cat? If you want to be sure you're not marrying a dog to the greatest possible extent, you have to do step one carefully. Otherwise, you will end up in a cycle of rough me out like this. Until somebody can't take it anymore and jump on the cycle. All right, very important. So this first step in the cycle is probably what? The most important. Absolutely. Okay? Perhaps the most step in the process of accounting. Period. I don't care whether you're dealing in hundreds of dollars or billions. You mess up this first step, dog eat your lunch. Identify, analyze carefully. If you're not sure, ask somebody. Do whatever you have to do to try to make sure that's step one. Because whatever you do in step one, it carries throughout the entire cycle. Wow. I tell board members all the time, when you sit on the board, when you make a fundamental decision, you have to be careful on what basis you make that decision. Because remember, the board is responsible for directing what? The entire company. So if the board makes a bad decision, they come up with a poor analysis of the situation. Not only does the board suffer, but who else suffers? The entire firm. You can't go on that board meeting playing games, which many of them do, by the way. That's why many companies end up failing. Serious business. Many of them are just interested in filling their pockets and nothing else. So if the company fails, the hell with the company. How about that? That's how serious it is. All right? And so when you're looking at the accounting side of things, you have to be thinking, is this firm doing all the things they're supposed to do from an accounting perspective? That's how board members, theoretically, who have some knowledge of accounting, like after these sessions, if you sit anywhere and there are financial and accounting implications, all of a sudden your mind is filled with, are they following the principles of accounting here? See what I mean? You don't have to be an accountant. You're just aware now. Yeah, I see. Don't bring that fruit over here. I'm aware of that. That apple. Because you know what? Let me put it over here by Daphne. Because the closer it is, she'll probably be before. So you have to be very careful. And that is what information does. It's supposed to make you aware so that you don't get sucked in unassumingly. into situations that can harm not only you, but the firm that you represent as a board or committee member. Or otherwise. Okay? Careful. All right. She sits at NIB doing it. Do you do any actual entries? Do you actually do entries? Yeah. Who checks them? Who checks her?
Actually, when no, she signs it, and it, after she signs it, it goes financial reporting, and financial reporting can bar the whole process and sends it on to the financial controller.
Indeed. So the financial controller ultimately sees the package.
Yeah.
So a couple of people see it.
Right.
That's called a system of internal control, and that's how it ought to be. Any one person who's authorizing it, that's a big problem. When one person only, you know that's a setup. Sooner or later, that one person is going to come up with something unusual, but very common. Yes, but very common. Creative, but very common. Ways to what? Embezzle. Steal. Absolutely. Okay. But at least you guys have a system of internal control where several people see the transaction. And therefore, for somebody to get away with something, it has to be what? Collusion. This is how boards get away with making stupid decisions that cause companies to fail. They collude because they're all buddies, slapping each other on the butt. And so when the time comes to do something that's detrimental to the company, but great for their pockets, they have no problem passing and agreeing, because they set that up before the time comes. And anybody who doesn't conform to that, all right, you won't be a board number 4 too long.
You'll just be an unhappy board member.
Until they get rid of you, they can't wait for your term to be up. Or they're going to try and find something to get rid of you sooner. Yeah, yeah, you're on on a church board. Yeah, they come up with some reason. Well, Brother John, the rest of the board, see, has decided that maybe this is not good for you. Praise the Lord. And thank you, Jesus. We've decided as a group, praise the Lord, that we'll just pray for you and ask you to step down, Brother John. Step down.
As soon as you rectify
Yeah.
your circumstances,
Whatever.
we'll be happy to have you
Yeah,
on the board.
yeah, and if-
But that
yeah.
doesn't happen, right?
No.
We
It's
give
just
you some
designed to
time
get
to
you
take
off.
care.
Yeah, of stuff. Okay. These are very real issues, by the way. In here, we're talking about the formal side of things. It's corporate governance and accounting and how to account for financial information. In the real world, that kind of stuff is very common. If you don't join the pack. All right. Step number 2 then. Once you're clear on the identification and the analysis, now you can go ahead and say, I know and I understand this transaction. Go ahead and what? Record it in your journal. We'll see that later. Okay. Once you've recorded the transaction, then you can post it. And when your posting is done, you can then go to your, what we call the unadjusted trial balance. Don't worry if all these terms don't fit yet, they will. Sooner than later. Okay. What's the 5th step? Yeah, I'm creating some adjusting entries, which we'll see later. And then after the adjustments, you have the 6th step, which is the adjust. In other words, these entries here will correct this, wouldn't it? And so then you have now the corrected trial balance. Okay. And then once the trial balance is in order, you can then go ahead and prepare step 7, which is financial statements. And then the final step in the process are what we call closing entries. Now, again, you're not here to be accountants. You're just here to kind of get greased up a little bit on some of the things that happens in the world of accountancy, so that when you sit on your board somewhere or committee and you hear these things, you wouldn't be like way out in left field. Okay, like I don't understand none of that, which is a big problem. All right. So what is the trial balance? Let me just say something about that before we go further. We'll see it later. This is the trial balance. over here on the left-hand side are the debits, and what's over here? Credits. All the trial balance will do is take all the debits in the company and what? List it. Well, not company, in the accounting ledger. And all the credits. And a perfectly run system with all the double entries correct would result in a what kind of trial balance? A one that balances. This figure here would be exactly equal to that figure. The debits would be exactly equal to the credits. That's why we call it a trial balance, to make sure that the ledger is balanced, to make sure that all the debits and credits were done what? Correctly. Now let's say your debits are 3,000 total, and your credits are 4,000 total. What do you think happened?
Difference.
There's a difference of 1,000, which means that somewhere along the way, one or several errors were made. You follow? That could be one error for 1,000, or it could be scores of errors for little amounts. Absolutely. Which means that when this trial balance is not balanced, so if you're a board member and you feel froggy one day because nobody's talking about anything important like the accounting part of things, while they're having coffee or something, excuse me, can I see a copy of the trial balance for this firm?
They can say, what's that?
Yeah. What are you asking the trial balance for? He's a rep or whatever. You know, accounts, right? That kind of stuff. Because that means that the first, and you, when you get the trial balance after today, what's the first thing you're going to look for? To see whether or not it balances. You don't need to be an accountant. You're a board member. You look at the big picture. All right?
But that's why it's spontaneous trial balance. And always tell you if something's going right.
Of course. That's why when the auditors come in, the first thing they ask for,
correct it.
no. So when you go in your board meeting, you ask, can I see the trial balance? You're like, what the hell?
And it shouldn't take them 3 weeks to give you a trial balance.
3? Hell no. They should be able to print it in less than 5 minutes. Don't, if they tell you 3 weeks, you have a big problem on your hands.
So I mean, a big company is within the trial balance, but not for the company, but they'll have a trial balance for each ledger, like each ledger.
No.
Together.
No, everything is big company especially. That means that everything accounting wise is electronic. Which means that all you need to do is go into QuickBooks or whatever your software is and press trial.
Yeah, I mean, maybe I have not been able to do it yet, but when they ask me to go and check through the trial balance, they want me printing for this particular type of account. That's what I'm saying.
You mean like a general ledger?
But I don't know, is
No.
the trial balance at the top?
Now, if you're printing a trial balance, a proper and complete trial balance, especially for your company, should be a pretty involved
I
document.
know, that's why I say, so they'll tell me print the trial balance for the long-term benefit. Or print the trial
No
balance
such
for
thing.
Royal Bank.
You can print an entry, you can print an account for one of them. An account, a single account, like this. One account called long-term benefit, with all the debits and credits in it.
That's
But
a
you
general
can't print,
That's a general ledger.
this is a general ledger account,
Okay.
okay? But if you're printing a trial balance,
Everything.
that had better have all the accounts on it.
Okay, let's put that in.
Because if it doesn't have
But
all,
don't press print, because you don't paper for days
I
on
know.
NIV.
I know. Okay.
Just don't press print yet.
yeah, just look at it on the
I
screen.
gotta look at it, yeah.
And scroll.
So you're like, what you doing over there?
Yeah, because they have a lot of debits and credits.
Right.
Okay? But that it should be a very long document in your
It shows
case.
everything.
Yeah, all the debits on the left-hand side and all the credits. And then scroll right down to the end if you could get to the end. And when you get to the end of it, the debits and credits should be balanced, equal exactly the same.
And let us know if it doesn't go.
And if it's not balanced, that's a big old problem. And I wouldn't want to be in your shoe to try to suggest to who shall I say this to. Hopefully it's in balance. But just do that as an exercise and see. Absolutely.
I'm sure when they tell me I go to all those tabs, and I know when I do tab, I have to put in the account number, and I'm only putting the account number for this particular account.
Yes.
Right, so that's the GLN.
Yes, that's an account that's in the GL. We'll see how that works in a minute. But that's one single account. And as you can see, as you can probably tell, NIB would have thousands of
Yeah, you
accounts.
do.
because of the number of clients and expenses and so on that they have. Absolutely. Okay? Because it's on and on and on. Alright? So that's just kind of an introduction to trial balance and why it's such an important document. Okay? And we'll see some of that other stuff later on. Don't worry about it. So that's the cycle. What kind of question you can get on the accounting cycle? List the accounting cycle. I'm not going to ask you to like get into any deep stuff like, no. I'll probably just say list the accounting cycle and explain one or two things. All right. Now the accounting equation is another interesting side of accounting. The accounting equation has to be learned. It's simple, but it has to be known just as you learn the golden rules. If you understand the golden rules, you can understand a lot about basic accounting. If you understand the accounting equation, you will understand even more about basic accounting. Okay? That can help you without having to get an accounting degree of any kind. Now, we are told that the accounting equation displays all what? Assets as either financed by borrowing or paying with the money of the company's shareholders. So, watch how simple this is all of a sudden. The accounting equation says that assets of the company must always be equal to, see? That's what that means in mathematics. You can't change it, you can't play with it, you can't turn it around to anything else. This means always equal to. Wow. That's why in the Bible you don't see that M is equal to F. Or F is equal to M. Males are not equal to females. Females are not equal to. So this is not an equation. Not mathematically speaking. Hell no. We make up our own equation over here. Yeah, something like that. Over here? Oh, yeah. The Venn is definitely applied to this madness. Yeah. All right. So in accounting, though, assets are always equal to plus. That's the rule, and that's what we call the accounting equation. If I ask that in the test question, don't panic about it. If I said, "What is the accounting equation?" Just write that. Now, if I said to you that the liabilities here are $10. $10 is the same as 10 trillion, isn't it? Once you get to the rule, it doesn't matter the amount. The principal never changes. We don't change the principal based on the amount. Okay? So if the liabilities are $10, the equity is 0, what are the total assets of this company? Oh, that concept wasn't too difficult, was it? $10. Similarly, if the shareholders' equity is $10 and the liability is 100, what are the total assets of this firm? 110. What about if the assets are $300? What would be that equal? What would that be equal to on this side? Where? Would it be this or this? Why not both?
It can be shared.
They share it.
It can be shared, or it can be on liability, or the shareholder equity side.
Yeah, it can be either one.
Yeah.
Okay? Now, how do we determine which one? You need more what? Information. Don't guess. Absolutely. The question is, to determine how this 300 is broken up is a function of whether or not a part of it or all of it are liabilities or equity. Now, a liability represents what? What you owe. And how do you owe? When you borrow, see? See that connection? Remember, the accounting equation displays assets, see this, as either borrowed money or money from the shareholders or the owners. You know that the shareholders are the owners of the firm. Anywhere. Okay? So in this instance, we don't know how much the liabilities are, if there are any, and we don't know how much the shareholders' equity is. But let's say the owners of the firm contributed cash of $250. What happens to the equation now? What has to happen for this equation to be in balance? Liabilities has to be $50. Does everybody see that? And it's as simple as that. And if this equation is not balancing, these two must always be equal to assets. Point. If you're opening up your own business, correct? Personally, and you need a van, cash in the bank to pay BEC, pay salaries and all that kind of stuff, you need assets, correct? For your business. Your business will be financed in one of two ways, either by borrowing or by you, correct? So, if you put up all the money here, then it means you have no liabilities, because you put up all the money, correct? If you don't have any money, you have to borrow all of the money, then your liabilities would be what? 300, and your input would be 0. Does that make sense? All right. And that's all the accounting equation is. But all the accounting equation is doesn't mean it's to be discounted. It's only a piece of cake now, because now you know what's going on. Without understanding this simple equation, you can be left in the dark about a whole lot of things in accounting, as you will see. Those golden rules, the double entry, the cycle, and this, so far. And let's not forget the foundation. What's the foundation? The principles, like everything else. If you go and get an education, 5 degrees, and you have no principle, you'll be an academic, educated, unprincipled bastard. But some people don't mind. Well, ask me to say it again. That one just came rolling from the... All right. All right. Moving right. So with that information in mind, armed with all of that so far, board members, non-board members, committee members, church thing, just remember now, with some of this information, you could challenge your pastor now. They don't want to hear about money issues. I have found out that pastors don't like to discuss money. Anybody has a pastor who doesn't like to discuss money? No? Your pastor discuss money?
Other than when they
No, not offering. Talking about how much money they made, the church made, and how it was spent. That's what I want to talk about. Your pastor does that? Stop the madness.
I know some of us mentioned, okay, we have a building fund that was going on, and this and that, but that don't be all over.
That's amazing.
So you have the
Well, other people have accountants too, but usually the account is in somebody's amen thing, sort of.
I had a church, visited a church of mine, say, I don't discriminate. Churches don't discriminate with money. The AML is what they call it. This way is washing money.
He said that in church?
He says the drug dealers money welcome. The number of people
He was just cracking a joke, you mean? Or he was serious?
Dead serious. They ain't gonna ask us today. This way you borrow your money, this way we just wash it in here. Bring your tithes.
The problem
All you
is,
bring them. You ain't got to declare nothing.
the problem is some money is washed in churches all over the world.
What?
Not all churches, but some churches could be deemed to be money laundering agents, just as some churches hide illegal immigrants. and they don't think they're breaking the law. But they'll be the first ones to say if your child get caught with dope, that they're breaking the law and should be what? Imprisoned immediately. But when you try to lock up the pastor for hiding an illegal immigrant, then everybody comes out and say, God can strike you dead. What, I don't know which God they mean. Because that God already said, render unto Caesar that which is Caesar's. And so if you're breaking Caesar's law,
That's a part of the law. They can't do them in church. They can't do them
Yes, they
in
could.
church.
in the Bahamas you could.
Really?
Yes. We just don't, because it's part of the culture.
I thought I read that somewhere.
In the U.S., when you run into a church, they're restricted, but not in the Bahamas. And why should somebody go to prison for breaking the law on one side, and others who do not go to prison on the other side? It's not fair. If any of you steal a loaf of bread to feed your children, they would still arrest you, wouldn't they? And say you're a thief. Then you say, I have to feed my children that's hungry. Nobody cares. Let them drop dead, beg, worry. My.
They have a bind of bread.
As they should be, because of my. Okay, so with those principles, equations, golden rules, and all this stuff under your belt now, let's see if it helps you through these basic transactions. And again, you're not here to be accountants. You're just here to get a feel for what accountants do, so that if you're in a meeting or an environment and something comes up, they won't be able to pull all the wool. Absolutely. Okay? That's the key. And you will be armed now with some fundamental things that you can use to help you make constructive inquiries. Like running that trial balance and scrolling down, just to see if those debits are equal to those credits. Now, don't get me wrong. Because the trial balance is in balance doesn't mean everything's fine. People cook the books too. But that's another story. Of course. If I'm short by 10 billion in the debit side, all I have to do is what? Pass an entry for 10 billion. And it balances like that, doesn't it? So when you run your trial balance, look to the end, you see it in balances. But that doesn't mean everything in that lineup is correct. And that's why auditors come in, to see if they can find whether or not somebody might be doing such a thing. Okay? They will look at that trial balance first. They'll have the trial balance, and they'll scan it. Large balances, unusual balances, transactions that are not the norm, all this kind of stuff. And anything that looks unusual, they'll say, can we see that? All are clicking down. Kind of sort. They don't say clicking, but that's what they mean in their mind. Because we need to check them, see? To make sure that this trial balance is really in order. Okay? All of a sudden you're sitting in an environment where there's a certain language, and whether you believe it or not, even though some of this stuff may not be kicking in right away, it's going into the subconscious. And when you're confronted in the future with crap, say, wait a minute, excuse me? No. The trial balance shouldn't work that way. Yes, I do. And as far as I'm concerned, this trial balance is out of balance. Furthermore, because it balances, it doesn't necessarily mean that everything is fine. Now, you may not know everything you're talking about. You're just talking about what you know. And that's all you need to know in a certain environment, correct? To get people to think like, kiss my foot.
Gotta be careful, gosh, you know what you're doing.
Yeah. Let us go try and fix it if it's not right. All right. So basic transactions. Let's take the transaction type. Remember, the cycle begins with what? Always. All right. So let us analyze what transaction occurred. We sold goods on credit. Now let's analyze that. If we sell it on credit, did we get any money?
No.
So therefore, what came in? Yes, something came in, but was it money? And accounts receivable came in. Yeah. So whenever we come in, what do? So we debit accounts receivable. It's not money, but it's money that you expect to get. Yeah. And in accounting, once you give a product away or service, you have to account for it whether you get the money or not. If you get money coming in, we debit what? If you get no money coming in, we debit? Yes. Because that receivable is your evidence that the transaction what? Occurred. And if Tom, Jones, or Susie, they do not pay, you will use this along with the source document to sue them, correct? To get either that or
If they don't have the money, so then it's double, you gotta write that off, yeah.
well, people write off a lot of stuff because people don't bloody pay. But people don't not pay because they don't have money. Of course not. Most people don't pay. Most people don't pay because they refuse to pay, not because they don't have money or they've lost their job or they're sick or something. That percentage is small compared to working people with money who just don't pay. Okay? I do consulting work on this, like for private clients. And if you see my accounts receivable, you'll be like, oh my God, because it's always growing. Going up more than it's going down. Because people don't like to pay. Yeah, we want it free. We want everything free. The only thing we like to pay are the doctors because we think we're going to dead. Or they might give us a bad needle.
Because the doctor ain't gonna give you no medication and treat you
Well,
till you pay.
that's what I
Now you
mean.
pay first.
That's what I mean. Yeah. And our lawyers. Because the lawyer says, if you want representation so you don't go to prison, pay first. Bastard. I was like, yeah, it's called retainer. And then they give you a big fat bill that had nothing to do with the work they did. And you can't prove it. So, my. Yes, my good. All right. So you don't want to have a receivable with a lawyer. The doctor won't let it because you have to pay before you leave. The lawyer, you don't want to say, send me a bill. Because that receivable that the lawyer will have on his books for you is hardly going to represent the amount of work that they would have put into your matter. And if you don't pay, they will sue you. And since they're lawyers, they can get a case in front of the magistrate when? Quick! And move it on your salary and your assets sooner than any other soul in town. You said it, that's something. Damn right. That is something. Okay. So we debit accounts receivable because the goods were sold on. If they were not sold on credit, we'd say goods sold for. Absolutely. See how that works? And what do we credit? Income. We don't have any folks. In accounting, you could have income with no money. That's why a lot of people go out of business. They have income of $3 million and no money in the bank. Why? Because the receivables are so high and the bills are so high, they're not collecting the receivables fast enough to pay the bills. So they are out of business. But they have great sales on credit. That's why you pass certain places, they tell you, don't flick in answers for no credit. Because they realize that if you don't control your credit, you'll be found wanting and out of business. Certain big businesses can give credit because they have ways to control it and run you down and make your life miserable. But if you're just an up-and-coming business or a certain small, medium-sized business, you have to be careful credit with this. Notice when you go to the gas station, you have to know the person very well to get credit.
Oh, really? You get?
Some people. Yeah, like people like Brent said, when did you get credit? Brent. Yeah. Frankie Wilson. But not no John.
Give it to some small businesses too.
Yeah, if you develop a rapport, yeah, they give you a small thing, you pay that well, and then you keep paying well, then yeah, you can develop a rapport. Yeah. But normally, they're not going to give credit. And there are some gas stations that you notice are no longer in business. Chances are it's because they gave too much and didn't get enough money to actually pay the oil companies when it's time to order what? Gas, olein. And since the oil companies no longer give credit, in the old days, the oil companies would give you gas stations credit, and the gas station would run up a big bill with the oil company. They have to run them down. Now, they don't want to hear a word from you until you give them the check first. Then you give them the check.
No, 2 days before, because I have to clear.
Well, that's what I mean. No, they're not coming on no potentially bounce. No. Managers check cleared. Then they're going to roll down with the truck. Not a minute before. No, John will start. But you can start it. Just go to people on this list. Okay? Absolutely. All right. So this is your typical accounting transaction for goods sold on credit. Anything on credit, this is your transaction. Debit receivables, credit income. What about down here? Same thing as this. Services on credit, same problem. Debit or credit? Credit. My. What about here? How do you know it's cash?
You said it. Cash
Cash
and grease.
Oh, you saw it here? Yeah, that's good. I was hoping you'd say that. Because it's sure not here.
Right, yeah.
So you see, you have to look at the big picture, don't you? You can't just make a decision when you're doing step one and analyzing like this, like the thing the horse has. You can't. You have to take the thing off and look at the big picture. All right? Now, what kind of stock do you think this is? Is this inventory stock?
That could be inventory.
Or is this shares of stock? In this case, it's shares of stock. Okay? So the company sells shares. When you sell shares, what do you get in? Yeah, the money comes in from selling, that's what they sell them. So you can get money. So grow the company. And what increases when you sell shares? Equity, because when you sell shares, more shares are out there by persons who own them. You follow? So your equity or your shareholdings increase as well. Any question on those three basic transactions? They're basic, but they're very fundamental. Okay? Give you a good insight on how to apply the debit credit rule, the double entry rule. Let's say that this stock was sold for $10,000. Using the accounting equation, where would I put the $10,000? Here? Okay. 10,000 is equal to, why do you say zero liabilities?
It's borrowed.
Sorry? How do you know we didn't borrow?
Sell stock.
How do you know we didn't borrow that?
Where did you get the money from the paper? What initial to get stock in? In order to sell it?
It's
You
shares
might
in the
sell a
company.
profit.
Isn't it?
It's shares in the company, right?
It's equity.
These are company shares you're selling.
Assuming they pay cash, I just put it to equity.
Well, what about liabilities?
Well,
Because the equation calls for liabilities.
well,
How do you know?
You don't know unless you have the.
Yeah, so say it again. Yeah, there's no information to suggest any liabilities, and therefore liabilities are equal to zero. Yeah, I know. You always knew. I'm just being the devil's advocate so you can see how it all applies. All right, plus, which is the equity that goes up. Absolutely. Because somebody or somebody's out there holding what, $10,000 worth of your shares. So your shareholdings out there will increase, as would your cash that you received for selling those shares. That's why companies sell shares, so they can increase their cash to do more business. Question? Okay. So now you guys are on something of a roll. Stuff that was a little worrisome and weird before, I don't believe are so weird anymore. All right? We talked about that, didn't we? So we don't need to, I think we've beaten the double entry to death a little bit. Okay. I am probably going to ask you to find what is double entry bookkeeping, just to keep you honest. And I'll ask you to write up the equation, just to keep you honest. And then I'll give you some simple numbers and tell you to work them in the accounting equation just as we did, just to make sure that, you know, when you're sitting in your board meeting and you want to do a little summary work to see what's going on in your firm, you follow? You can do that. For example, you don't need to know a bloody thing other than the accounting equation right now to go into a board meeting or any meeting, for that matter, and say, ask three questions. Watch this. First of all, call in the CFO, financial controller, whoever that person is, and say, Mary, what are the total assets of this firm? She said, I'll show you. Don't show me, Mary. You're the board person. Don't show me, just tell me what it is. You don't need to show me. I'll take your word for it at the moment. Okay. Total asset in this firm is 30 million. Okay. Fantastic. Thank you, Mary. Don't go yet. Because you're writing up your equation, aren't you? And then so you put in, she says, what do you write? Mary says, what are you writing? Don't worry, Mary. Just answer the question. What are the total liabilities of this firm, Mary? 60 million. You see a problem already?
All right.
But you don't want to jump to any conclusion, no? You want to finish your equation. Plus,
So
see, that you don't want to mix up your equation. That's what you bloody learn. Keep it simple until you can do it mentally. Until then, you write the whole freaking thing out. Because you don't want to mix yourself up either.
Just like grade school.
Absolutely. Because that always works. Mary, what are the total equities in this company? Shareholders' equity. 120 million.
Minus.
Now, according to the accounting equation, these two added must equal this. Well, when we add these two, what do we get? 180 million?
How come Mary said that a deficit too?
You would have to say verify.
How come we have a company?
She said 60 million.
Well, Mary's just recording. That's the other thing. Mary's not the problem, unless she didn't say anything. But she's just recording the transactions based on the decisions.
But I thought Mary is the financial controller.
Yeah, but the financial controller only records and makes sure the information is correctly put in the
She
system.
would identify the errors before she records.
She have to let the board know.
Well, the truth is, there's no error here. It's just that business is horrible.
Houston, we have a problem.
Now, if the financial controller saw this coming and didn't say anything, that's a problem. Because their job, part of their job is to, you know, send up the red light. Auditors might come in and play crazy like they didn't see it. But sometimes they do. But technically, is this company insolvent? Yeah, this company doesn't have enough assets to cover its debts, right? Doesn't have enough assets just to cover its own debts. And whenever you don't have enough assets to cover your debts, you are insolvent. Yeah, you are bankrupt.
We've been the regulator.
Well, hopefully there's not a bank. And if it was, the regulators would see it long before it gets to this. Because every month you have to send them a balance sheet.
Yes, yes.
Sometimes the regulators watch it closer than the company board. Because the board meets every 3 to 6 months talking stupidness. And sometimes they may not even look at the reports. See what I mean? But the regulators request it if it's a bank, for example, or insurance company, every month. Absolutely. And the insurance commission.
Man, the penalty.
Absolutely. Make sure your reserves are in order. Make sure this accounting equation is in balance. And make sure that the firm is solvent.
The high penalties for not reporting and reporting the right information.
Big time. Well, you could lie on it because they, you know, if you can hide it, fine. Because they're not going to try and act as your auditors. Even though they spot something, they are going to say something. Because they will want to know what's wrong in this particular area and why isn't the firm picking it up? Why isn't the board being aware of it? And why are the auditors making a little rumble about it? Not just. The insurance commission was here when Clico was here. And we still want to know how the money,
young.
But they weren't there, their mother company were invested locally, so when they have companies invest abroad, so when the market went down.
Whatever, I hear you, but whatever it was, the commission is supposed to make sure that a certain amount of reserves are kept in
Right.
place to cover existing policies, and then say to the insurance company, if you want to take a chance with what's left. You can't touch the reserves, because we will not approve that payment.
Well, obviously somebody had
Who?
their friends supposed to be, it's not never.
Who in the central bank, probably not the central bank, because the central bank would have been instructed. I'm sure the governor, who was Wendy at the time, in a way, she was going to do that. Somebody had to do that around her, I believe. Or I don't know. Put a grenade must be in her mouth. That'll blow you to sweat. No doubt about it. The question is who? We never found out.
The prime minister, that's who.
Well, you know, we know stuff
Who's
that
doing all
he's
this
scared to
stuff?
say.
The prime minister, this country.
England by the time, to be exact.
Mhm.
Okay. So now all of a sudden, these things, we start opening up new horizons once we start getting into this stuff. And that's really the idea. This stuff is not designed for you to become accountants. This stuff is for you to be aware of what's happening in the financial accounting world, so that when you get into your environments, you can understand some things, ask certain questions, make certain applications, okay? And even say, by looking at these numbers, something is clearly wrong. Okay? And that's really why we're here. All right. More double entry. Okay. But there's something else about this I need to say. Just for the record. Notice, in accounting, a debit does what to an asset? What does it do to an expense? What does it do to a liability? And to equity? Just another rule like the golden rule. Don't worry if you don't understand it all yet. You didn't understand some other crap, but now you do. It all comes together. Okay? A debit increases assets and expenses, and it decreases liabilities and equity. Soon and very soon you'll see how that works. The credit is the opposite. You see that? Does anybody not see the opposite? Not to see the opposite. The effect of a credit is the opposite of the effect of a debit. Just another rule like the golden rule and like the accounting equation and so on, and the double entry process. Don't worry about it. Just remember it just the way it is. And eventually, soon before this semester is over, it'll all make sense. Guaranteed. All right. Now remember we talked about journals earlier? Now what is a journal entry? It is an entry into the journal. Well, what is a journal? A journal is a what? Record that keeps in what order? In what order? What does chronological mean?
Date order.
Yeah, in date, proper date order. Not helter skelter. The 3rd, the 7th, the 9th, the 1st. No. That's not chronological. If you see a journal set up that way, that is a violation. And it might be a violation not because of ignorance. It might be done on for some unknown reason. Until the truth is told. Okay? Chronological. Now, if you look at this general journal, this general journal could be a piece of paper. It can be an accounting entry with a bunch of lines on it. Whatever saw the old accounting sheets with a bunch of lines on it. No, they're not very popular anymore because everything is electronic. But basically, it could be a simple piece of paper or accounting paper with lines just like this. This journal is now sitting electronically in the system. So if you want to see a general journal, you have to print it out of the system. And if you print it out, it should look like that. Doesn't matter that's electronic. Remember, the rules don't change. The computer only does it what? Faster. Doesn't change the rules. Shouldn't change the rules. And any computer that's changing the rules, you have a problem. It's not the computer. Somebody is hanky, panking, or they don't know what they are doing. So how does the journal look? Manually or computer-wise? Well, GJ means what? Journal, page 1. That's how we used to do in the old days manually. And that's how it should show up electronically as well.
That's how it should.
Sorry?
Now, that's how it should show up now.
Yes. Even if you print it off the system. And notice the components of the GJ. The date, the account title or name and description, the reference, which we'll see later, that's not a big deal for you guys. And then, debit on the left, credit on the right. Typical journal, manually or electronically. That's what it looks like. Okay. What goes into the general journal? Transactions. In what order? All right. So, 2018, chronological, August 1. That makes sense, doesn't it? Can anybody look at that entry, that double entry? How about that? That makes sense now? And say, what happened? What happened? Even though you're told? Cash came in. How do you know?
Debit.
Yeah, the debit who comes in.
Or somebody was borrowed.
Yeah, payable. Anything payable means you owe. Anything payable. Okay? So, in this case, it's a note, meaning you owe money. Because you borrowed 50,000. Any good journal entry should always have the year, the date, this information, the explanation as to what occurred for us to leave a what? Audit trail. If you don't see this information, then you have to try and figure it out, don't you? And as the transaction gets more and more complex, then without this information written under here, you have to go back to scratch and try to figure out what the hell happened. This in accounting is called a narrative, or an explanation of the transaction. Very important as an audit trail. Some companies and bookkeepers and accountants like to leave out the narrative to create confusion. Or if they're trying to hide the nature of a transaction, they may not put a narrative in.
Hang on.
Yes. Or you might see, narrative, tingham.
Miscellaneous stuff.
My. Yeah, yes. If you see miscellaneous or tingham as a narrative, you need to audit the whole firm. Because they ain't serious. Because miscellaneous, for the most part, is usually designed to hide. Okay, Jamal, you ask your wife something, she said, don't worry about it.
Give me no more.
That's exactly right. And that's a man's next question. What do you mean, don't worry? A man hates that expression. You want to create suspicion and ruin your relationship? Keep telling your man, don't worry about
Don't
it.
worry about it, I'll figure it out.
Yeah, or it's okay. Or I'll find someone else to do it.
I'll get it done. I'll get it
You
done.
are setting yourself up for something egregious. A word to the wise.
Sufficient.
Now maybe you don't care. So you can tell him anything you want to tell him. But if you care, don't be careful with that kind of stuff. Guys hate that. And even though guys do jump sometimes, guys hate doubt. Like, we want you lie before you create doubt. Lie first. We don't like lying either. But we prefer you to lie. But don't create doubt. Like, who was that? Don't worry about it. Lie. Say that's your cousin. Or something. But don't tell him, don't worry about it. Yes. Why you need to know. See that? Man, we hate that crap. You want to make a man miserable? Start talking in that language. I don't know if that's a debit or credit. None of the above. We just hated it. Don't believe me, ask him now. And he's a youngster. He just reached. No, that's another thing. Don't tell us don't ask. We hate that too. That's why a lot of guys.
Like, why you ask?
I don't know the answer.
No, what you want to run for?
Yeah, what you want to know for?
Yeah.
That became her.
And let me tell you guys a little secret that you already know. Maybe, or maybe you don't. When you start using that kind of language, sometimes it's the beginning of the end.
Slippery slope.
May not look that way to you. And some chicks don't care, they can't tell.
It's something else.
I want you to go on there and
Yeah, but I'm just saying, for those guys who you care about, yeah, that's not going to fly. Seriously. Even though you look like you're getting away with it.
But you can't
Like every time you do it, he looks like he has his tail between his legs. Some guys walk with the tail behind.
Yeah.
But that doesn't mean that
Right,
they're
yeah.
not dealing with it.
That dealing with it.
Other guys can't take it, so they
I've seen
start
that
fighting
happen.
you.
Yeah, some physically be
Yeah, they
and
as
others,
soon as
they
you
make
say
it
it,
that transition.
they so impatient. Like I have an older brother, he used to be like that. He's calmed down a little bit now. He's 60 something. But that guy, you tell him yes. Like, wow. The minute you open your mouth with something off the wall like that,
He lived long though.
well, yeah,
In his era.
Yeah.
Couldn't have been in this era.
no.
You know, not there.
No, I'm not saying that was not the right thing to do. Just that, like, some people can take, like, some of us can just walk off and suck it up. And that's why women like to say that, because most of us just walk off and suck it up. You know the thing you're doing. Yeah. And like that. If there's any man, you see, like that. But there are a few guys who cannot take it.
Yes, friendship.
And then they'll run up all over your face and egg you right up. And then that's not the appropriate thing. All right.